Hello, my name is Jessica Burge, and I am doing my case study for financial management on KOHLS Corporation. I'll start with the company's history. The company began in 1962 when Max Kohl opened the first Kohl's department store in Brookfield, Wisconsin. In 1978, Battis, British American Tobacco, purchased an 80% stake in the Kohl's food and department stores and took complete control of the company. Later in 1987, the company was purchased by Kohl's Management. Kohl's ranked 8th in Wisconsin's top 100 privately owned companies, and the following year was Kohl's greatest growth rate to date. They purchased 26 Main Street stores from Federated Department Stores, moving the stores into new markets in Michigan, Chicago, and Minneapolis and St. Paul. In between 1988 and 1992, Kohl's sales increased from $388 million to $1 billion. In 1993, Kohl's became a public company and completed an initial public offering of 11.1 million shares. In 2000, Kohl's operated 298 stores in 25 states with 43,000 associates. Their headquarters is located in Menominee Falls, Wisconsin. They have 1,154 stores in 49 states, and they're the 20th largest retailer in the United States in 2013 in terms of revenue. As of 2013, Kohl's was the second largest U.S. department store company by retail sales. The product line offered by Kohl's is Craft & Barrel, Apartment 9, Sonoma, Jumping Beans, and Tech Gear. These private brands generate nearly a half of the firm's $19 billion in annual sales. Kohl's also offers public brands such as Nike, Puma, and Under Armour. Moving on to Kohl's industry overview. Kohl's faces a large amount of competition from other major retailers, such as Macy's, Sears, JCPenney's, Bon-Ton stores, and Nordstrom. Amazon is one of the most recent and threatening competitors right now because of the convenience and hard-to-compete prices. Although they're not a department store, they offer a lot of things that Kohl's and other department stores can offer at a reasonable price. The business profile of Kohl's includes primary revenue, geographic presence, and customer profile. The primary revenue, private labels, as stated before, generates nearly $19 billion in annual sales, making this their primary revenue source. That accounts for over 40% of their revenue. Their geographic presence is nationwide with stores in 49 states. Although recently, store closings may affect this. For their customer profile, their typical customers at Kohl's include middle-class shoppers who like to save. This shows how in tune Kohl's is with their customer base. Their marketing through coupons and Kohl's Cash is brilliant. And although customers are probably spending the same on like items available at other retailers, the feeling of saving keeps them coming back. Recent news and announcements include these three listed here. The first one that I'm going to describe is the store closings signal big change at Kohl's. This is a CNBC news article from February and talks about the big changes for Kohl's department store and stores that they are closing. Come June 2017, they stated that 18 Kohl's stores would be closed around the U.S. An announcement was made that after Kohl's fiscal fourth quarter earnings, that they would close these stores. The CEO, Kevin Mansell, expressed that the store closures were the most they've planned on at one time in the company's 52-year history as a department. Kohl's revenues have stalled at roughly $19 billion over the past 4 years. Kohl's is now looking into ways on how to boost sales and profitability. The company is changing their strategy with plans to eliminate underperforming locations and open 14 outlet stores and off-aisle stores. The second article is called "It's Not Just Macy's. Department Stores Are in a Death Spiral." This article goes over why department stores are struggling. Online retailers are providing convenient alternatives to department store shopping. American consumers spent a record high of $91.7 billion in online sales during the holiday season in 2016. That is up from 11% in 2015. Amazon is the world's largest e-retailer and accounted for about 40% of all of those online purchases during a certain peak periods. The third article that I'm going to mention is Kohl's profit grows, helped by traffic gains and tight inventories, but sales are still shrinking. This is another CNBC article that talks about the most recent May 2017 report that Kohl's earnings of 39 cents per share and $3.84 billion in revenue for the quarter. This deviated from the analyst's expectation of 29 cents per share and $3.9 billion revenue. This represented a 14% jump in adjusted quarterly profit for the first quarter, which was attributed to an increased inventory management and higher traffic in the stores in between March and April. When looking at financial condition of KOHLS Corporate, it is stable with limited growth. Kohl's revenue has remained constant over the past 5 years. They are facing challenges, but Kohl's still remains a stable corporation. Throughout quarter 4 of 2016, Kohl's and Nordstrom emerged as relative winners between all department stores with the same store sales, while comparable retailers' sales fell. They are implementing new strategies to overcome these barriers, such as outlets and smaller specialty stores and online marketing and online sales focus. When looking at free cash flow for KOHLS Corporate, it represents the cash that a company is able to generate after spending the money required to maintain or expand its asset base. This graph represents Kohl's free cash flow over the last 3 years. You can see that there is a dip in 2016, and at this point, Kohl's had made the decision to close 18 stores and focus on their inventory control. They also focused on investing in online improvements and remodeling current stores that do well financially. Looking at historical stock performance, comparing the stock performance to the S&P 500, the performance is more erratic, which I believe is due to shopping patterns. One other important point to notice is that the trend over 4 years, the stocks are back to what they were worth in 2012. Although Kohl's is doing better compared to other department stores, which would reflect the orange line on the graph, there has not been much growth over the past several years. I personally would not invest money in this company. Looking more in detail at KOHLS Corporate over the last 2 years, you can see the periods of growth that can be attributed to seasons when customers are shopping more. The highest peak represents December 2016, right before Christmas. Dips in the stock prices can be attributed to less shopping, for example, right after Christmas and during the summertime. This slide displays the price to earnings ratio, and it is common practice for investors to invest in the price to earnings ratio. to determine if a company's stock price is over or undervalued. Companies with a high price to earnings ratio are typically growth stocks. For comparison, I chose two similar department stores, Macy's and Nordstrom's. And for fun, I added Amazon into the mix because I know how well they're doing. Kohl's is very comparable to the other department stores, but you can see that Amazon is doing extremely well. When looking at current capital structure, the total capital is equal to $9.6 billion. We have 47% debt and 50% common stock for KOHLS Corporate. This has changed over the past several years by being pretty consistent with the numbers that are displayed. And they're very similar to competing department stores. Moving on to KOHL's dividend policy. The dividend yield average over the past 5 years is a 3.25% average. Their current dividend yield is a 5.9% average, which is much higher than others in the industry. A dividend is a payment made by a corporation to its shareholders. It usually is a distribution of profits. When a corporation earns a profit or surplus, the company pays a proportion of the profit to its dividend to shareholders. Dividends show a company's strength and also appeal to investors because they like the steady income associated with them. Usually, well-established companies do this to appeal to investors. A company that is still growing rapidly usually will not pay out dividends because it wants to invest as much as possible into further growth. The cash conversion cycle includes inventory, accounts receivable, into cash, into accounts payable. The inventory turnover is 12% over the last 5 years and is longer in 2012. Payables received have increased. This is reflective of the struggles they have been facing with inventory management. The payables period is how fast they pay their vendors over time and has increased, representing their increase in time to turn over their inventory. Their operating environment is large inventory investments, and their inventory has low turnover compared to past trends. Consumer market is changing because more consumers are preferring to buy online. So their growth opportunities include refocusing investments in online sales and marketing, building additional customer relations, eliminating underperforming stores, renovating high volume stores, and reducing inventory to match customer needs. The reason why these growth opportunities would be effective is because the consumer market is changing. They like the ease of shopping online, and department stores have large spaces that are not being utilized like they used to be. In conclusion, I would say that KOHLS Corporate would not be a good stock investment. Over the last 5 years, there has really been no growth in the stock. Although KOHLS has been a stable company for years, I think many department stores are facing serious threat. Their future depends on how well they can accommodate the online sales demand. Improvements that the company plans for the future seem to be in line with the market demands. The outlook completely depends on their ability to meet the needs of the customer and changing with times. I hope that they can meet these goals and that they can change with the market.